Oh, good afternoon, or good evening, or good morning, wherever you may be. This session today is going to be on using some of the custom indicators that are built into AIQ. When I say custom indicators, I'm talking about Expert Design Studio indicators. That'll be the first 30 minutes of the session. In the second half of this session, I'll turn it over to David Wozniak of Trading for Research, and he's going to be looking at some IPO primary breakouts. So that's today's session. You probably just heard the recording is on. I'm not sharing my screen yet, but I will shortly. And we've got about 45 people registered today. Most wait for the recording, but I appreciate those of you who turn up for the live session. If you have questions, I'd appreciate it if you could put them into the chat area, and I'll endeavor to answer them as we're going forward. So it's last day of November, an interesting turnaround day on the market. We won't be going into that today, but we will be looking at the Expert Design Studio area, these custom indicators, and I'm going to focus primarily on bands, on the upper area of the price chart. So let me just share my screen. Right, if you could just type in the chat real briefly, or Y, if you can see my chart up on the screen there. Can anybody see my chart on the screen? Great, thanks, David. Great, appreciate it. Okay, so first off, my colors are always in black. I like the contrast between that. Usually I have them in yellow or red. That's fine. You're very familiar, I'm sure, if you've been in AIQ charts as long as I have. The barometer on the right-hand side of the chart here, all of the standard indicators, I currently have all of them loaded in here. Any of the indicators that have a barometer color of the standard built-in indicators within the system itself. So they're kind of coded, hard-coded in there. You may have noticed from this chart here, I have a DUG that underneath the indicators that have barometers, which are canned, I have the 6 that don't have a barometer value on there. And these are the custom indicators, or in this case, custom bands that we're going to have a look at today. Now, there are 2 ways of a recap, I guess is probably the best way to look at this, of how we go about adding a custom indicator. And let me just show you where these custom indicators are if you're not familiar, or if you need a refresher on that. The Expert Design Studio, which of course is launched from the main menu, from the EDS icon here, takes us into our system design tool, where of course you can build your own indicators or trading strategies. What we're using it for today is to grab these custom indicators, and they are all located in File and Open, and in your WinTest 3.2, which is your program folder, there's the EDS Strategies folder, and inside that Strategies folder that comes with the system, by the way. I mean, if you were to download the copy onto a new system today, you will get all these strategies and these different folders in there. And the strategy folder we'll be using today is Charts Custom Indicators. So when you open this folder, this is what you'll see in here. There's an alphabetical list of different files. Each of these are design files that have been coded either by my staff, or have been coded by people out there who have provided them for us. A big shout out goes out to those coders who do that for us, because some of this coding can be complex. And so the ones that we send out with the system that you have include a variety of different custom indicators. Some of them are sourced by client feedback, some are sourced from stocks and commodities, and some are just indicators that are very popular out there. As you can see, things like Chaikin oscillator, dial oscillator. All of these Expert Design Studio files are custom indicators. There's no differentiation in this folder between the indicators that would go below a price chart, like a histogram, for example, or those that are trading bands that go on a chart, on the actual price chart itself. That differentiation we make, we will make that differentiation when we add these onto a price chart. I went through here. I mean, as I say, there's a lot of different ones you can explore at your leisure. When you open up any of these files, of course, like I opened the Donchian channels here. So that one is actually right down here in the D's, of course, Donchian channels. When you open that, you get exactly what I see in here, which is an already accepted tool for putting bands on price action. The coding is not particularly important to know. This is an extremely simple indicator because it just looks at the high value of the high and a high value of the low at a predetermined number of days, months, weeks, whatever period you're using it from, and then plots these as a band for high value and the low value. So it just makes sense. It's a simple one to start with. If you wanted to use a different number of periods, all you would have to do is come in here and change this and then save it. If you do that, that'll change how this indicator will look on a price chart. So to actually apply this to a price chart, I don't leave the EDS file open. In fact, I'm just going to minimize it to make it easier on myself here. And what I'll do real quick, just to show you how we do this before we have a look at the indicators, the trading bands in action. So I have the Donchian upper and lower already in place. So briefly, Donchian bands, it's a well-known and tried and tested technique. It's been out there a pretty long time, I think probably since the 50s. I mean, really all it is comparing this line here, 20 days is what we have it set to. It's looking back for the highest high over 20 days, and it plots it. And then the next day, it looks back 20 days and does the same thing. Very, very simple, very, very straightforward. We'll look at how these can be used in a second. I just want to continue on the functionality process here. So for adding a custom indicator onto an upper level of chart, we'll need to go to chart, and we go to settings, and we go to indicator library, and we go down to EDS indicators. So that's that Expert Design Studio. You'll notice that I have a whole bunch of them in here. There's no limit beyond the fact that if your processing power wasn't that great on your computer these days, you can have any number of them in here already queued up. The way that you add a custom indicator is by simply clicking on the add button here, and it will send you straight to where you need to go and look for it. Remember, we looked in WinTest 3.2, EDS strategies, custom chart custom indicators. So I would select whatever one I wanted to add out here. In this case, I had Donchian, and I can just add it again if I really want to. But to click on this, I click open. What this does is it primes the charting area to look within the code of that file for definitions that we can then apply to the pricing chart. So in this case, what do we do? Well, we've got one line. We have one line with support, 2 lines. We have 2 lines with support, 1 line with upper and lower limits, histogram, or histogram with plotted line. Now, when we're doing bands like this, we do one band at a time, because then you have both bands available there. So you can switch one off or switch the other one off. So it's a double-step process to add an indicator to a price chart, as opposed to, for example, if I was making an MACD customized that I built myself, I could probably put that into either a histogram or a 2-line with support, and there'll be just one indicator right beneath the price chart. So in this case, what we're going to do is we're going to take the one line and click on next. And then you give the opportunity here, and I'll just call it Donchian, just to differentiate it up from what I've already done. Now the area here, it says UDF, that's user defined function. That's what we're looking for, a definition of what does the system going to display for us. In this case, we made it very clear. This was in the EDS file itself. Upper channel is what we're going to do, and we are plotting it on the price chart. That's the key thing. Once that's done, it's finished. I can click done. You notice now I actually have another Donchian in there. I would repeat this process for the lower one. So we then Donchian lower. And I would, instead of doing the upper channel, I'd click the lower channel instead. So that's how you apply them to the price chart itself. You already noticed I have some others already in here, and these are ready for us to go look at in a moment. So Let me get back over to my area here. Okay, so Donchian channel. So Donchian, as I mentioned, it's been around a long while. It's a really simple calculation. There's not really a lot to say about how you use these channels. It can actually give you an idea when you have a trend in place to the downside, when the price action continually keeps touching these levels. So often you will think bands, right? You hit the outer band, and it's kind of like, well, maybe it's overbought when it's on the upper band, or maybe it's oversold here. But it's also very useful when you see this type of trend in place. So you get to this point, say, where it's cut through this lower band maybe 1, 2, 3, 4, 5 times. If you're at this particular point within a trend, so I'll click the date back here, zoom in on that a little bit. No, wrong one, there we go. You see this happen quite a lot. It gets to the lower band. Remember, this is 20 days, so you're looking at sort of a month's trading going on here when you have that setting. And when you see the trend is already like this, and it's just like a continuation of the trend is going on. So I see this more as a useful indicator that the trend is likely to continue. You could say when you get a cut through, yeah, that might be it. It's even more oversold. But overall, if the pattern of the indicator, the lower channel here is going down, and I keep touching it, it's a sign the trend is going to continue. There's nothing to change that until we see something like this happening down here, where it begins to flatten out some, in which case it sort of oscillates between the lower and the upper channel. Now, the same is true on the upper side. So if I slide this back just a fraction here, go back to a period where we're going much further up. So you see the same sort of thing happening on a good move to the upside. So like here, so when prices have gone sideways for a while, it's very clearly defined at this point here. When prices go sideways for a while, you get this happening. It's very flat. It can be up, and then it can be down again. But once you start seeing the steps start moving up again and prices go above, this is like the beginning of a trend. And you can get in kind of, after 1 or 2, maybe 3 crosses over, you get the trend is beginning to form. You get to this point here. Again, let's zoom that in a bit. Yeah, it's a little harder to see on this chart because I've got such a big move down over there. I'm just going to squeeze that a bit. So you can see it a little easier here. Again, once the trend is underway, you don't really know it as far as Donchian is concerned until you get to here. So it's kind of midway through, you've had 1, 2, 3 cut throughs. So that's kind of the, one method of using Donchian. The method that I've heard a lot about, channels, well, it's overbought when it's at the upper band. Yeah, but it doesn't really work that well. You do get pullbacks. I mean, check this one out here. I mean, we're looking at, this is the ultra short oil, right, which has gone down pretty significantly over the last sort of 3 or 4 months. On the way up here, it cut through several times and did pullbacks, but it's still in this period up here in a trend to the upside right here. So the same goes here. Once you get down to the lower band here, a couple of cut throughs, it's the trend in the direction that seems to indicate how this works best, especially when you're in good strong trends here. I mean, it cut through many, many times here. That's not an indication to go long. It's an indication that a trend is actually in place. So Donchian's quite good for that. A couple of other stocks in here before we look at a couple of other indicators. See, again, the same thing happens here. I love this pattern here where it gets above, we are in a trend to the downside over here. It's in a sort of a transitionary place here. And then you start this move to the upside. It goes through, but it's a trend in place. Yeah, it pulls back. That's not, that's just a pullback. While this is still moving up, it seems to be it's a very good indication of a trend in place. So it cuts through that upper band, it pulls back a bit, maybe a good re-entry point when that happens. So this is the way, there are other interpretations, and really I think Donchian works well with things like directional movement to give you a little bit more information, or even RSI, relative strength index together. So, of course, we're pressed for time today, so let's move on to Keltner. So the same thing I did with Keltner, I pretty much used that same process. We won't go through it. If you need to look at the video, you can see how you add the indicator. In this case, the Keltner file is this one here. Our file name is keltner.eds. So the difference between the Keltner and, say, a Bollinger is to do with the averages that it used. Instead of using exponential, it uses simple averages. And the way this particular channel works is also, again, looking at the angle of the channel for trends. In this case, when a price moves above the upper band, it often shows price strength again if the indicator is in an uptrend. But a drop below the lower band shows price weakness, and again, if there's a trend in place. And quite often, again, you'll continue to see the prices hitting the upper band. And when this does, eventually it will reach the lower band at some point. And when it does that, that's usually a sign that the trend is over. So again, the calculation of this, it's all here for you to see. This is kind of the standard settings for the Keltner, and you can obviously vary these. The moving average is set to 8 in this case, and it's using simple moving average. It also has the ability to plot a center line, which we won't be doing in this particular instance. What I've done is just do the upper and the lower line. And really what this does is it uses kind of it's the average range is multiplied by a certain constant to give us our upper and lower range bands for the indicator itself. So again, in the charting area, if I pop up the charting area here again, get that over there. So no need, no point in overlaying lots of bands on each other. It's really hard to see. By the way, if you want to change the color on these, so in this case, we're now looking at Keltner. You'll notice that these are in yellow for me. Hold down my control key and I can click on the second one. You notice that this one's in yellow. Either of these can be double clicked on and you can change the color. Unlike regular indicators that are actually part of the control panel where you can actually change constants, when you double click on one of these, the only thing you have that you can change is the color, because the constants are all based upon the definitions that are in the Expert Design Studio file. So if you want to change any of the constants on these, you need to go into that Expert Design Studio file and do it. By the way, I find it good practice to, if I change a setting on an indicator, and this is something I would suggest you do, put a comment in here. So if you change a setting, put an exclamation mark and put your date, say November the 30th, change the moving average to 15, testing a new moving average for the strategy. And then when you save that, it'll still be Keltner, but when you come back in and look at it another time, you'll know that what changes you made in here. The alternative, of course, is you could always change it, save it as a different name, Keltner 15, for example, and then that would leave the original file in its pristine condition. So here we are, Keltner. Notice this is a very different method here. Control key, put the upper and the lower. One of the things that's, again, the cutting through the upper band is usually a pretty good indication that there's a trend in place. The interesting thing with this I found is that it's not, dissimilar, not dissimilar to a widening and squeezing that you get with Bollinger Bands. But, Bollinger Bands, when we look at the last one today, Vitali's exponential moving average, which is similar to Bollinger Bands, is a little different tool. So here, our basis for the bands is based around the average true range, but times by a multiplier. So it's simple enough. The average true range obviously is another separate indication of the actual average range of price over a given period, and then multiplying that by a factor to the upside and to the downside gives us the actual ranges for the upper and lower bands themselves. This particular indicator, it's a couple of stocks in here, or a couple of ETFs. I find, again, this with the value set to 8, you get a lot of this going on, where it's already passed through the band itself to the lower side. So you do get the same type of thing when it's doing this. soon as this continues all the way up here, when it cuts back through here, usually means the trend is definitely changing to the downside. So it's a pretty good indication when that happens. It cuts through the lower band. You're going to get a move to the downside. There's a few stray ones like this. I mean, this was moved to the upside and cut through here. So the other thing, key thing in mind here, if it's cut through the lower band, you need to see the trend of the lower band going down. So in this case, it needs to go down. So when it cut through here, it's flat. Still too soon. When it's still cut through here, the trend is beginning. So it looks like, then you're into a downtrend. Here's the same thing here. It's popped right back through the upper band. It's great to use this type of, quite what I would call moves in a fairly gap opening fashion to give us a little idea of how this works, because then you don't get it moved through once, and then you don't get a trend showing in the indicator itself, the band itself, and it moves back through the band here, and within a couple of days we're back down again. So your trend of the actual band itself with a cut through tells me it's going to keep going down. The same happens up here. I mean, you might get a little whipsaw there. It's true, because it's cut for a couple of days and it's begun to move back up. But as soon as the trend is lost on this, that indicates that you're not really in an uptrend at this point. Happens again here. This point here, it cuts through. We're flat. When we get through this point here, it's cut through again. There's already a trend moving to the upside. So it's a good sign that things are continuing moving up. So that's kind of the upper and lower Keltner channels, as they call it. The other things that you might have, I didn't actually look at in the EDS file itself. Again, a lot of these indicators that have channels can also be put together with a sort of average line in between the two. I haven't found that particularly useful, particularly in this indicator on the settings that it's currently set to at 8. But here's another example of it right here. You get a great move up here. This is an even better example because the trend is up all over this period here. Even if you started here, it's cut above it. Trend is still up. When you get to here, you're still in the trend. You're staying with it. Suddenly, it's cutting back down here. Once it's back through here, the trend is over. This is not, entry points are here. This is not about exit points here. This is about, is it going to change? When you get to here, if you were saying, well, it looks like it's the beginning of a downtrend, well, where's the trend on the Keltner low? It's not there. There is no trend. So that one's, that would be ignored. As it happens, price action went right back up here. As soon as the trend began moving again, price action is right above this band. It just continues on in that fashion. Quite a good indicator that way. Quite good. Again, it's not, I wouldn't say for exiting positions, but for getting into a position. Again, you can see it on the lower band here. Price is cut through once. Once it cuts through a second time, you've definitely got a trend in place to the downside. You can ride that all the way down. Exiting strategies, again, not something I would consider using Keltner for. So Keltner, next one up is Vitali. Now, Vitali is, let's have a look at the Expert Design Studio on that one, which is down here. Let's find, oh, we don't want Zoom, we want this one. Here we go. So this one is also in that custom indicator folder. If for any reason you don't have a copy of any of these, we can drop me an email at support@AIQsystems.com, or have Laurie or myself can get those out to you. Vitali, his indicator is kind of the way I would look at it. It's almost like a Bollinger Band, but not. I mean, it's not an easy way of describing it. It's like an exponential standard deviation is a band, is the way he mentions it. And they're very similar to Bollinger Bands, but they use the exponential moving averages rather than simple moving averages that John Bollinger does. So you get a slightly different band. Again, the calculation in here is not of interest for us. Thank you to Rich Denning, of course, for coding this back in 2019. This one was off of the technical analysis, stocks and commodities article, the Traders Tips in that magazine. If there is an article in there that has an indicator that they're discussing, and we are able to code it within the framework of Expert Design Studio. We usually do, or Rich Denny does that for us, and that is then available for us to use within the software. So that's where this one came from. And I like this indicator. Again, this is very similar to Bollinger Bands. You get the volatility increasing and narrows as volatility decreases. And, you know, it's generally designed, Vitaly mentions, along with other indicators, again, such as ADX and directional movement. So let's have a look at what this looks like within the charting area here. As I said, not going to show you the mechanics of putting it in here. In this case, I've got Vitaly upper and I've got Vitaly lower. So again, both one-line indicators. And let me just put the color together because it makes it really clear on when we're looking at it. Zoom. And that's one is yellow, and then we'll do the other one, the other two. Okay, click happy there. Colors, and then yellow. Click OK. So now both the Vitalys are showing as yellow. So there you have it. This is just quickly notice. Remember, I said Bollinger Bands. Bollinger Bands is slightly different than calculation. So when I click on upper and lower Bollinger, check this out. So you can see there's a definite difference. It's not huge because the Bollinger uses the moving arithmetic rather than the exponential. So that's the difference between the two there. Overall, the squeeze and the widening is very much similar. You know, the increase and decrease in volatility can indicate a change in direction. Cutting through the upper bands on the Vitaly is actually pretty good. I find it's you don't often get it happening like when it's over here. It does happen. You do get a pullback happening. And the same here. Remember, this is the Vitaly. Notice the Bollinger Band gets cut through a few times here on this down leg. You see that here, this down leg. But the Vitaly Band, it doesn't happen. As it happens, you're never going to signal on that particular one. So again, you have two areas you can look at: the squeezing when the bands are getting closer together, lower volatility often at the end of a move up before any acceleration to the downside begins. You know, once a move is going downside, notice the bands are widening. That's a typical situation you see both in Bollinger and in Vitaly bands. So less signals for these crossovers to the upside or the downside on the Vitaly, whereas with Bollinger, it's interesting here. You see you get crossover here and here, get a bit of a pullback, but you get crossover here of Bollinger, but it doesn't really do anything until we get up to here. On the Vitaly, we get one crossover here, and that's about it. So it's a more, again, of the squeezing of the bands indicates the possibility of a change in direction. Let's check out another ticker in here. What have we got? That's Japan. These are ETFs, by the way. I just happened to work on. This is the MSCI Emerging Markets. So again, here's a crossover of the band up here. Get a pullback at that point. The Bollinger Bands, again, as you can see, there's just a slight difference, but you do seem to get a lot more of these crossovers on the Bollinger than you do on Vitaly. So Vitaly's a little less whipsawed. Saying that, you know, you get this happening here. This is common as well, where like we saw with Donchian and like we saw with Keltner, no, more really with Donchian, it's you get these situations where you get into a trend and it's trending quite strongly down. It's going to keep hitting the band. But the trend keeps moving out. But once you get a trend in place, the reversal really needs to happen with some pretty big movement in the band itself. In the case of an exhaustion down the bottom here, the bands begin to narrow. See this particular band has been going down here, and this one is sort of flattened out. It's going up a little bit here. Once you get the squeeze on the volatility, like it does here with the Bollinger Bands, you get the squeeze. That's a sign that the volatility is lowering. So there's not a lot of action going on at that moment. You know, price action was in a sort of channel here. Bands begin to expand out again, just like do with Bollinger, as volatility starts to increase, and we started a trend to the upside. So a real quick session there, just on those indicators. We have, of course, as I mentioned before, there are indicators you can add to the lower pricing area, below the pricing area, like I have here. I've got ease of movement, or I've got Natenberg's volatility. These are all, again, indicators that are built into the Expert Design Studio that you can attach to any of these charts. And most of those indicators will have a description within the Expert Design Studio file, just like these ones do, the Tali one. Exponential deviation bands. You can check in Technical Analysis, Stocks and Commodities magazine for information if you want any more information on how to use those particular ones. So,
all right. My name is Dave Wozniak. I'm Chief Market Strategist at Trading Floor Research. And today's topic, as Steve said, is primary breakouts, PBOs. And so let's just get started right in. Here's what we're going to cover. I'm going to define a primary breakout. We're going to talk about the components of a primary breakout, and then I'm going to have, we're going to show some application with some examples at the end. So the first thing, even before we start defining it, why? Why do I even want to talk about primary breakouts? Why, what's the significance here? And the thing I have to tell you is in my for almost 34 years of doing this now, the thing that I have found when I go back over my trades is that the biggest and best returns that I have gotten over the years have come from primary breakouts. And to the extent that if somebody said to me that I could only have one system of, be able to trade one thing of all the different areas I trade, what would I choose? And I would choose primary breakouts. That's how significant the returns have been over everything else. And not to say returns haven't been good in other areas, but primary breakouts are just unbelievable. So that's why I want to talk about them today. And so let's go ahead and define what I term a primary breakout. And of course, a primary breakout occurs when an initial public offering or an IPO breaks out of its first, and here's the key right here, well-formed base. So what do I mean by a well-formed base? Well, there's three areas that I really focus on in a well-formed base. The first is not a must, but it increases the probability of success that the market is in a confirmed buy. And again, that's not a must, and we're going to see examples this year where I traded primary breakouts and put them in the newsletter, and the market was not in a confirmed buy. Of course, we haven't spent much time this year in market confirmed buys, but the primary breakouts did work. And so the whole thing is especially in markets that we're in right now, is that to me, it comes always down to probability of success and probabilities. So even if the market is not with me or different things don't quite get where I want them to go, I'm still going to maybe take the trade, but I'm going to lower again my asset allocation to it. I'm going to make some adjustments in what I'm doing. Now, the second area that is a well-formed base for me is a must. This one is a must. The industry group is in a buy signal. That is a condition that has to be met. The third one, the IPO is under accumulation. Again, this is a must, and we're going to cover both of these as we go through today. It's in an accumulation, and it also is forming a proper base, whether it's a cup and handle, a double bottom, even if whatever the base is, I have to determine that this is a properly forming base. And there's a couple of keys that I use in order to really get that across. And so we're going to be talking about that as this goes on here today too. So let's first start out with a couple of examples. Again, there's so many examples I could give. You know, I traded Tesla coming out of a primary base, and actually that primary base was what I like to call a coiled spring. I traded Facebook coming out of it, which Facebook was a gap up in the $30 area. But Chipotle was another example. And I'm just showing a couple of examples here to kind of get the point across, because there's a couple of things that are, you know, very, you know, that I do not have to have it exact in doing this. And one of them is the length of time it takes for a primary base. In this particular example, of course, the IPO came, rallied up, very typical with IPOs. And again, in my primary base, I don't care about the IPO when it comes to the day it comes to market. I don't care about that. I care about, from that point on, how is that base forming? What is going on with that? And very typical, you're going to get a run up, and then you're going to get a decline that a lot of times will look like a cup with a handle type formation. In this particular case with Chipotle, you had a breakaway gap and started running away with this thing. A key that we're going to talk about as we go on with this too, again, that works into a well-formed base, is the idea that the handle, or when I'm purchasing this potential primary breakout, always one of the keys is it has to be trading above 50% of the range. Why is that? I've said this numerous times in webinars and everything else in classes. This is a big thing for me, is above 50% of that base, the bulls are in control. Below 50%, the bears are in control. And for the bulls to take control from the bears, it takes a lot. There's always a war that goes around along 50%. And so in this particular case, this base took about 1.5 years to form, the primary base. And that's kind of typical. Facebook, Tesla took about 2 years. Facebook, it's very typical that they take that long. Now, once they do break, I mean, you know, Chipotle was a fantastic example. If you hung on long enough, that was about a 5,800% return. One of the key things that I'm going to talk about too is what I look at in determining how far I'm going to ride a primary breakout. And one of the big things is I use trend lines, and where trend lines cross at key Fibonacci areas, those are areas that I point to. And actually, I use this in all my analysis to get ideas where I'm going to exit. But in primary breakouts, it's the same type of idea. And again, you could see how this thing was just bouncing beautifully on its Fibonacci numbers that I set up. And then you got a second base in here that you took off from. What's really interesting is, to me, when I have a major trend line like this that goes through the chart and we break out the top, typically this is where your chart will go parabolic, and also typically works as the top, a really, really significant top in the move. And that's why I think Chipotle may have hit a very significant top at this point. We've come back down through a very significant number and actually threw back into the trend line and that significant number at this point. So we'll see where Chipotle goes from here. But again, just buying the primary breakout and letting these things go to the key numbers. Here's another one, Alibaba. Alibaba actually took almost 2.5 years to form its primary breakout. And again, I didn't care about the IPO itself. It just, you see these and look at how beautifully it formed right at 50%, that handle. The bulls stayed in control. And once it broke, in about 11 months, you had 102% return. If you held it into the second base and bought it out of that again, in 3 years, you ended up with about 204%. And again, rallied right up to its key number up there before it let go. So those are just some examples of a couple primary breakouts that I've actually traded. Again, there's so many more, and again, the returns have just been incredible. But for me, like with everything that I do in technical analysis, it's very, very exact what I'm looking for in a primary breakout, and it really has to fit certain parameters before I'm going to trade it. So in other words, just because something is setting up in a cup and handle doesn't necessarily mean I'm going to go chasing this thing. And I'm going to give you an example of one that I just recently put in the newsletter, that the first attempt this stock actually took in breaking out was a failed breakout because it didn't meet my strict parameters. And so I'm even going to show that to you too. But here's 3 components of a primary breakout that really do need to be met at this point. And number 1, again, I need a buy signal from the industry group and a buy signal from the IPO itself that I'm looking at. That's number 1. We're going to cover that. Number 2, I need to see that accumulation in the base as it forms. I need to see shares being accumulated by big money. And number 3, I need to see a well-structured base. How do I determine that well-structured base? I use what are called Gann grids, and I break the base up into 1/8 numbers. And those 1/8 numbers tell me so much information of what I need to know as this IPO is setting up in this base. So we're going to cover all 3 of these. The first one, the buy signal of the industry group and the buy signal of the IPO itself. And so again, I need that confirmation from the industry group. And again, it's nice to have that additional confirmation of the market. And a lot of times the market, when it's just turning down and you're getting confirmation of an IPO breaking out, typically that's a very good time to really step back. And especially if the group isn't giving you a buy signal too. The IPO that is setting up in the first stage base has to be in an industry group that's giving you a buy signal. And what do I mean by a buy signal? Well, Steve teed this one up pretty good for me here today because one of the rules, I have 5 factors in what I call my early entry system. And number 1 factor in my early entry system is Ghanchian's four-week rule. Now, one thing that I have to point out to you though, and again, I'm really not going to go in depth in these. You can actually see, I've done another webinar with Steve that you can actually see where I talk more in depth in the early entry system. But these are the factors that play into when I say I'm getting a buy signal in the IPO and I'm getting a buy signal in the industry group. It is the early entry system. One of the things though with the Ghanchian rule for me, when I was back testing this many years ago to put this into my system as a portfolio manager, when I was using this, one thing that I learned in back testing this is Ghanchian's original rule was that price, as you see with Steve's chart, price just needs to break the upper channel. That's Ghanchian's rule. What I found was in order to increase the probability of success, and again, it's all about increasing the probability of success. What I actually found was if price closes at a 20-day high, it immediately increases the probability of success. Now, again, the other things that are increasing the probability of success is volume. When this is making a 20-day closing high, I need to see confirmation of volume, above average volume. I also need to see trend already playing in place. I use proper order of moving averages, and I also use trend lines, which we're going to talk a little bit about today. And the other thing is again, I use these Fibonacci numbers to make sure the base is properly put together, and I use Fibonacci expansions to get better exit points. And we're going to talk a little bit about that today too. So back to the idea of a group then. So, and again, these were examples of industry groups earlier this year. And by the way, coal, I've already pointed out in my newsletter already, that's been in a buy signal for the past few weeks already again. Coal has just been a monster here. But I'm going to use this coal example again. The industry group gave a buy signal on January 12th. Okay, the market, and here's the key, the market was in a sell signal. Now, again, that lowers my probability of success. I have to take that into account in my trade, that my probability of success might be lower because the market is in a sell signal. But a great buy signal using my early entry system, you can see the volume, price, breaking the trend line, proper order of moving averages, everything was in place. And by the way, then the group gave a beautiful throwback into the trend line and took off from there. But the idea here is the group gave a buy signal on January 12th, earlier this year. Immediately, what I'm always going to do, because again, my best success always comes from IPOs breaking out of bases. When I get a buy signal in an industry group or a sector, I'm immediately going to look for the IPO. That's going to be, for the IPO that's set up in a base. And if that is what is giving me the best accumulation and everything else, that's where I'm going to focus my effort. In this particular case, one of them that went into the newsletter was AMR, Alpha Metallurgical Resources. And this was actually, I didn't put the full chart over here. You might see it in another chart I give. No, you won't actually. But this actually came in around 2017 or so, went pretty flat, traded up to its high around 2018, formed a cup, a handle. And what was interesting was in the handle, it actually formed a cup and a handle and then took the whole thing out. When did it take it out? Well, took it out just after we were getting our buy signal in the industry group. So here we go. We've got our buy signal in the industry group. This stock gives me the buy signal. And what do we get? In a market that is declining, in 24 trading days, a little more than a month, we get an 81% return on this thing, right up to my Fibonacci target area of 126, coming right in. Actually, after it pulled back from there, it even went further at that point. But that was pretty much my trade, right out of, a primary breakout in a horrible market. Another example, looking at earlier this year, looking at the oil and gas exploration and production industry group. Same type of idea. We got a buy signal in the group, perfect buy signal. That buy signal came really close to the beginning of the year in January of 2022. And this primary breakout stock actually didn't even give the opportunity until about a month later. But Indonesia Energy, look at this thing. It just came into a great base. Once it broke out of the base, 670% in 2 weeks on this thing. And again, this is the power of primary breakouts. This was a horrible market in February. But you know what? The group was there, and the stock gave it to you. And again, this is the power of putting those two ideas together. We need to get the buy signal in the group, and we need to get the buy signal in the IPO itself, the IPO that's setting up in that primary base. The second component is I need to see accumulation in that base as the base forms. Now, again, I'm getting my final signal of big volume with my 20-day closing high, my Donchian rule with big volume. That's the spark that starts the fire. But the kindling underneath that fire, the accumulation, has to be happening during that whole formation of the base. So how do I see that? Well, I need to see, again, that accumulation. As the IPO is setting up in its first stage base, I need to identify that big money accumulating of the stock shares. And how I do that is what's called up-down volume ratio. I'm always referring to this in my newsletter. It is unbelievably important to me in identifying when big volume is entering the picture in these different in whatever I'm buying, whether it's an industry, looking at the industry group, whether it's looking at the sector. As I pointed out this past week, one of the most distinctive things that I'm seeing in I can't think of it now. The consumer discretionary group in our sector, and what's really making it very, very intriguing right now, and pointing it to a leadership category right now, is the fact that it's one of the biggest up-down volume ratios right now in all the sectors that I follow. And this is finally overtaken even energy. Energy, the whole year, was the biggest up-down volume ratio that I was seeing. And that's what really kept energy at the top. Now, consumer discretionary has taken over as the biggest area right now. I'm sorry, it's consumer defensive is what I want to say. So anyway, what is this up-down volume ratio? And I know I've talked about it before because it is very, very important. What makes this so important is that this ratio looks over the past 50 trading days, basically about 2.5 months. And what you're doing is you're taking the upside volume over the past 50 days and dividing it by the downside volume over the past 50 days. So if you've got an up day with whatever volume's associated with that, that goes on the numerator. And if you've got a down day with whatever is associated with that down day in volume, that goes in the denominator. And why it's important for 50 days, or I feel it's important, is, again, institutions don't typically buy everything they want to buy in one day. They're buying over a certain amount of weeks or days, and they're putting these positions together very slowly so they don't influence the market. And one of the best ways to pick up on that institutional flow that I've found is using this up-down volume ratio. So when the ratio is greater than 1, that's telling me we've got accumulation. When it's less than 1, in other words, the denominator is greater than the numerator, we've got distribution. And so this is a key for me. And this is how, when this base is forming, the IPO base, this is what I want to be looking at. So let's go back to my example of AMR. All right. As AMR was forming, here's my up-down volume ratio. And in this particular case, what I even really put in there in my charting is I put the Donchian channels for 100. When up-down is breaking 100-day highs, it is very, very significant to me. This is telling me not only are we trading above 1, at this point, when this base was starting to form and coming up the right side of that cup, what we were seeing was we were seeing up-down between 1.5 and 2, but it was also breaking to new highs. Comes back, again, takes out 2 as this thing is coming into the last turn of putting in that handle. And then we settle out in that handle. But as this handle is starting to break, what happens? You get that confirmation again, and this sucker's off to the races. That is what's telling me, not only, again, I'm getting my signal of when I'm supposed to be buying this thing, but addition to that signal, I'm seeing confirmation of true institutional, true big money buying into these stocks. And that's what I want to see. Here's an interesting one, and this is a point I want to bring out with this, where one of the factors for me also is the idea that it doesn't matter how long the base is or when the base comes after the IPO. I'm scanning these stocks and always watching these stocks for whenever they set up in potential primary breakout bases. And what's interesting is this one happened earlier this year, and it was one that I actually picked up for myself. But what you're going to notice, here's the key on this. This is not a daily chart. Here's when it IPO'd, and this is a 30-minute chart. So each one of these bars, of course, represent 30 minutes of trading. And look at this, though. Here's your cup. Here's your handle forming right here. I always want to know 50% of that base. Where did the bulls start to take control of this base? And when I got a buy signal on this, right above 23, in the 23 to 25 range, I picked up some shares of this thing. Now, the bad news, well, the good news for me was it was in a matter of really another day or so when it achieved about, my second target was at 65, and that's where I actually took it off in a very quick period of time. And I thought, wow, that's pretty good. I mean, because this was a bad market at the time. And this was, in a bad market to get that kind of a return, I thought I was doing pretty good. The only bad news on that was if I would have held it for a couple more days, I actually would have gotten over $2,400 off of this trade. This is the power of these primary breakouts. This is what I'm talking about here when you identify these things. So this little mistake of not holding it long enough, and again, it was only a matter of holding it a few more days, would have gotten me definitely the trade of the year, $2,400 in a matter of days. And but it all begins with a primary breakout. And that's why I'm talking about this. This is powerful, powerful stuff. I give these type of things in my newsletter too, which we're going to talk about one that is currently in the newsletter here in just a bit. The Gann grids is number 3. A primary breakout, the third component that I'm looking at in a primary breakout is that the chart is set up properly. And how do I know it's set up properly? I break my chart up into 8s. So in other words, they're called Gann grids. And I go from 0, 1/8, a quarter, 3/8, a half, 5/8, 3/4, 7/8, and 1. And each one of these 8s represent a certain degree of strength and a certain degree of weakness. Let me just first start out by saying this, and again, I've already said this here today, but it is so important. The strongest numbers in this grid are a half, 0, and 1. And the focus here always has to be on a half. That, again, is where the bears and bulls take control from each other. The second strongest area is a quarter and 3/4. And the weakest is an 1/8 and 7/8. Knowing that and now putting that into the structure of a base makes this base so much more understandable. So let's look at a stock that I actually just recently put in the newsletter and was a buy here. But what's interesting is that buy has come off of this cup and handle that has started to form on this. What I didn't go with, if you can see this was, okay, so here's the stock rallying up, forms its first cup and its handle. And it you know, to the blind eye, it looks pretty darn good. I mean, you've got what looks like the potential for a primary breakout on this thing. So why didn't it work? Well, this is as much good information as anything else. And it goes back to these rules that I've talked about. So, you know, and what I've found on these kind of things, though, too, is when you get a failed breakout or a broken pattern, and you come up and set up for a second time, oftentimes it's the second mouse that gets the cheese. So we'll see what happens on that. But right now, let's focus on a couple of things here. December 28th, 2000. All right. Number one, giving December 20th, 2021. That was a big thing against it. But again, that's something I like to see. But you know, I can work with that, but it lessens my probability. The one thing that definitely I can't accept, and we're going to come back to this idea of the broken pattern too. Well, I might as well cover it right now. So the one thing that I do have to tell you, when you do make a mistake and you're buying a primary breakout, typically trend lines are going to tell you right away when you're in trouble off of this. And it's when I determine right away that you've got what's called a broken pattern. And the thing about broken patterns is that they can be more significant in the opposite direction than even the pattern itself that was allowing on the upside. So very important to watch this. And one of the keys for me in determining a broken pattern is to watch when you break that rising trend line that led into that handle from the bottom of the base. Once you break that rising trend line, that determines a broken pattern. In addition to that, you also look what you broke at the same time. You broke the 3/4 number, which was a very strong number. One thing I want to point out here, though, too, this is where my numbers play a big role in what I'm doing here, too. Look at where this move terminated. It terminated at the 8th number, at 1 1/8. Very, very important. Why is that important? This price should have just plowed through that number like it wasn't even there. That is the weakest number. The 8th and 7/8 is the weakest number. Instead, it hit it like a brick wall. That's your first clue that you're going to have problems in a breakout, is when you try to take out an 8th number and you fail at an 8th number. And so that was your first clue. You were put on high alert if you did take that trade. The second one was the broken pattern on January 13th. But let's look why you shouldn't even have considered that pattern in the first place. Was number one, as this was forming up here, look at what was happening to your accumulation, your up-down volume ratio. Not only were you in distribution below 1 at the time, you were breaking 100-day lows, and you stayed down there. Again, accumulation was not there. And what was more significant is, at the time of this breakout, you actually were experiencing distribution. So you got your key off of your Gann grid number. You got another key off of your your up-down volume ratio. And let's go for the third one. The trifecta on this is, let's look at semiconductors, where the stock, or the IPO, the stock is in. You got your first sell signal. Again, using my Donchian rule, you got your first sell signal on December 20th. All right. When was this thing breaking out? It was breaking out on December 28th. You were already in an industry group sell signal. And if you don't like that enough, look at what this sell signal was coming with. In a few days later, we were breaking 100-day lows on the up-down volume ratio and actually in distribution. Then what do you get? On January 19th, you get a second sell signal. And now we are deep in distribution on this thing. Okay, so it all is coming together, telling you you shouldn't have been taking that trade. That's why it is so key. That's why I find it so key, and that's why I'm so strict with these rules in these primary breakouts. Those are the things I'm looking at. So let's look at the difference now today. Look at your group today. Look at semiconductors today. You actually had 3 buy signals. You've taken out the entire trend line from the December highs. You've taken out this trend line, and this point should not go unnoticed on semiconductors, because I have to tell you, technology itself has not taken out this major trend line. Semiconductors have. You've taken it out, you've thrown back into it. I'm not showing what happened today, but you are right at the top of the range again here today. So you had a buy signal on the 10th, 11th, and 15th that took you into where you're sitting here today. Now, this is a problem. And again, just to acknowledge this, we might have had the buy signals, but here is a little bit of glitch right here in semiconductors, though I still have to tell you, if you look, they are 0.98, slightly in distribution. You might call it neutral, but what I noticed today, this was not, I didn't put today's chart in here at the end of today, but the up-down volume ratio on the group today, even with the upswing, went to a 0.94. So again, this, again, I'm taking the trade, but I'm realizing that, you know what, you got to watch this stuff really, really closely in here, because this is not the perfect signal that I want to see, okay? And again, when we're in better bull markets, you're going to get better perfect signals. But this is just something to be aware of right there. So here's where we are, though, today on this Allegro Micro ALGM. Now we're in, by the way, the up-down volume ratio on Allegro, though, is 2.12. Massive accumulation on this thing. What has this done in terms of the numbers and everything else? Well, here we are. Of course, we had to put in new numbers now again, too, by the way. We're not using the same numbers from before because we hit new lows. But here we are. Here's our cup. Here's our handle. Now, our handle started forming the minute we broke 50% of the range. And by the way, that's when I put it in the newsletter to give the buy. Now, once we got the buy signal, what did we rally up to? Well, we rallied up to a very important Fibonacci number, got held up at 3176. What did they do the past week? Exactly what I'd expect. We throw back into the trend line again. And today we closed back above my 5/8 number, 30.99. We actually end up closing at 31.14, right above my 5/8 number today. So the next thing we got to do is we got to take back that 3176, and these become my target numbers. And we're going to talk a little bit more about this in the next couple of slides about how I determine where the highest probability of target numbers comes in. But we're going to leave that hanging for now. But right now, that's putting it all together for Allegro where I see it right now. And here we are. How high does an IPO go after the breakout? Well, we use it. What I like to use is my Fibonacci expansion numbers and my trend lines, and a nice combination of the two. And of course, I've done a Fibonacci webinar before, but the expansion numbers from the Fibonacci number system, you can basically divide 89 by 55. You're going to get your golden mean, and you're going to get your continual expansion numbers by taking 233 divided by 55. That's going to give you 4.236, on and on, all the way up with your expansion numbers. When you put the combination of the two together, now this was where Beyond Meat, which was another one I traded on the IPO, when Beyond Meat was coming to the end of its line here, you could put a beautiful trend line above price, which you're going to see me do this on a lot of my charts for good reason. Where that typically comes together of where a Fibonacci expansion number is, typically gives you a pretty significant high. And that was the high on Beyond Meat before it really started to collapse. That was around $220 a share. Of course, I think Beyond Meat is in the teens now or something. So, once you hit those areas, it is very, very important. But I got to tell you, getting up to those areas on the primary breakout, again, can lead to very significant returns. So let's go back to our Allegro Micro Systems chart again. Now here's what's interesting. Remember that trend line that I used as to determine my broken pattern? I'm still going to use that trend line. Those trend lines come in play. Look where that trend line is taking us right now. That trend line's taking us right up to my Fibonacci expansion number at 49.83. Here's the other significant number right now, taking us beyond my Fibonacci number right here. But where it is kind of crossing right now is also, if you notice these lines, these are Andrew Pitchfork lines that I put in my charts too. And those also work for me as crossing. Where you see those Andrew Pitchfork trend lines crossing my Fibonacci expansion numbers, those will also trigger significant areas where I'm going to highlight where price is going to maybe have a little bit of resistance getting up to those areas. So 38.66 and 49.83 are key numbers that I'm going to be watching as this thing goes. But again, the whole idea here is let's get above 31.76 right now and see where we go from there, okay? Couple real quick examples right here. Some things, this hasn't even gone in the newsletter yet. These are just setting up right now as primary breakouts. This is ESAB Corporation. They make welding machines and things like that. Look at this. Again, here was our IPO, rallied up for a couple of days, came down, formed a beautiful cup. Look at what we formed over the past week or so. Great handle. Look at how it's forming. Today, we tested again, tested that 50% of the range right here. And we're ready to break this trend line of the handle right now. What makes this significant for me? Well, number one, we got the buy signal in the IPO. On November 16th, as we were taking out that trend, the 50% of the range, look at the buy signal. Look at the volume on that Donchian 20-day high, 4-week rule. Look at the buy signal on that thing with the volume. Big. But more importantly, even, look at my up-down volume ratio on this thing. Look at what up-down is doing right now. It's just a monster. As this thing's going sideways in this handle, look at the accumulation that's coming into this thing right now. This is big. I'm going to be watching this. This one, again, this hasn't even gone in the newsletter yet. This thing looks fantastic right here, okay? Let's look at the group. It's in the Diversified Industrials group. What's the group done? Well, it broke its downtrend line from its November highs. And it's given 2 buy signals, came and threw back into the trend line, all right? Look at this. As this was forming up, coming in, look at the strength. look at the amount of accumulation that came into this industry group. And again, we're getting close to a 100-day high on this, but we are in accumulation on this too. So we've got a pretty decent buy signal in the group right now. I like the group. So here's what we're looking at. April 13th was our high point in the cup and forming the handle. Here's what I'm looking at right now. Here's my key numbers I'm looking at on this that I'm going to be watching as this goes. One of the things I always like to do is draw that trend line across the tops right here. It gives me a key point to be watching, 66. We'll see what these different things go. You can see how this also works into my Andrew Pitchfork numbers. Up-down volume ratio on ESOP right now is 1.6, looking very good. All right. Here's an interesting one, just a fun one to finish this up. This one just came, I put this slide in today. This just came up today. And I talk about these 30 minutes, okay? And this comes up on my scan today. This A-Tour Lifestyle Holdings, ATAT, ATAT. This is in the leisure lodging industry group, which gave you a confirmation buy on October 31st, okay? And this was an IPO on November 11th. So from the daily chart, you're not getting a heck of a lot of information here. I put it in anyway because I wanted to show where my target numbers are on this. But guess what? Guess where this is setting up? This is setting up on the 30-minute chart. This is a 30-minute IPO setup right now. So we'll see what happens with this. But what makes this interesting is, if you may have noticed today, one of the big things going on today, and I put this past weekend, I put RLX in the newsletter, which is moving along here out of its base now. But one of the reasons it's moving along is because Chinese stocks are starting to catch fire right now. And this happens to be a Chinese stock. And again, setting up in a 30-minute base. Here, look at your accumulation on the 30-minute right now, 2.23. By the way, the daily accumulation on this is 4.1 right now. The 30-minute accumulation, which is what I focus on right now, and look at how it's already breaking. In this case, it's not 100-day, but it's 130 minutes. You're breaking 130 minutes to the high. You take out this trend line right here, and we're looking at these target numbers right here. Those are my next target numbers on this thing. And that's pretty much all I've got for you today. Check me out on LinkedIn, Twitter, or you can email me if you have any questions or anything, or you can even text me at this. And I'm going to turn it back over to Steve.
Great. Thanks, David. I appreciate that. And we'll get another session going again soon. Any questions, pop in the chat box, or questions for me, send to shill@aiqsystems.com, or actually send them to me, and I can always pass them on to David as well. Well, David, I look forward to working with you again in another session, probably maybe in January. How's that sound?
Sounds good.
Yeah, I'll talk to you soon.
All right.
Thanks, folks. Yeah, have a great holiday, everybody.
You too. Bye.
Bye-bye.